Hey guys, it's Nick, and I love ice cream and I love a good deal. So when I was in Walmart the other day and saw Turkey Hill ice cream, the 48-ounce size for $1.50, I loaded up on them. And normally it's like $4 or $5, so it was more than 50% off. Now, that is how most people buy physical things like food, clothes, and supplies. The cheaper it is, the more they buy. The funny thing about stocks, though, is that most people are more interested in buying stocks when they are getting more expensive and much less interested in them when they are getting cheaper. So the ARK Invest ETF is now over 50% cheaper than its high of about $160 almost a year ago in February 2021. So should you be loading up on it like a great deal on ice cream? Well, that depends on the ingredients. So let's have a look at what's inside the ARK ETF today and see if these companies look like they are ready for a turnaround. So this is a look of all the stocks in the ARK ETF. There's 43 of them as of today, January 18th. So the first thing I want to show you is the price to sales of all these stocks. So price to sales is just how much somebody is willing to pay for the business. So if I was standing on a street corner selling bottled water and I sold $100 worth of bottled water in a year, this 1.29 price to sales would mean that somebody would be willing to pay $129 for my business. Now, that's not a bad ratio right here, but that's on the low end. Let's see the high end. So the price to sales ranges all the way from 5,161, 990, 232, all the way down to 1. So pretty high right there. Most price to sales are in the single digits. Next, let's look at earnings per share. Shopify has $26 per share in earnings. Coin has $9.79. CRISPR, $4.76. Funny thing is, there's only, 11 out of 43 companies that actually have positive earnings per share. And the worst of them, Robinhood, almost minus $10 per share, and a whole bunch of others that have negative earnings, which brings us to the price to earnings ratio. One company has 2.7, 7.7, 13, and then it goes up to 334. Tesla, which is now cheaper than it used to be at around 1100 PE. Funny thing is, though, after Tesla, they're all blank, right? So 42 companies have no PE because they have no E or no earnings. Maybe they didn't have earnings in the past, but going forward, maybe they are expected to have earnings. So let's see here. The forward PE is 1200, 544, 284. And it stops at number 17 at a 25 PE, and the rest of them still have no expectation of any earnings going forward. So let's look at their performance in the last year. Tesla's up 22%, Trimble 8%, Intelia 2.5%, and then it ends there. Everything else is down at least 10% and down as much as 88% on Berkeley Lights, Invitae, and other ones. So here's a look at the monthly chart of all the stocks that's in the ARK ETF. And looking at them, you see that they are all pretty much on a pretty big downtrend. I mean, Berkeley Lights was almost 120. Now it's like $10. And VTA was 60. Now it's like 11. Skills was 45. Now it's 5. A lot of these things are indication that these stocks are, I don't know, they lost their mojo. People lost faith in them. They don't think that they're going to survive or they're not going to come back anytime soon. You know, these run-ups are when everybody was believing the great story. But now, maybe after a few quarters of continuously losing money and maybe the stock market bubble is bursting, people are coming to their senses and dumping these stocks that have high valuations with little or no earnings. And some of these stocks have a very short track record, like Unity, Roblox, Path, TSP, Coin, DNA, Hood. They've just been public only a year or two max, and they're already tanking pretty big. So what does Cathie Wood have to say to the people that have been holding during a 50% retracement from the high of ARKK? Despite the big plunge, Cathie Wood sees her plan returning 40% annually in the next 5 years. Now here's a look at the ARKK ETF on a monthly chart, and it was almost 160. Now it's below 80 and hitting the 50-month exponential moving average, which strong stocks usually get a nice bounce off of this of at least 10, 15, 20%. Not to say ARK is not going to bounce at some point. It is very possible. However, if you are a long-term holder, you should be aware of the type of stocks that make up this ETF. And for me, long-term, these are not stocks that I want to hold personally. So now going back to this article, she says, the opportunity in our strategy is huge right now. We expect a compound annual rate of return of roughly over 40% over the next 5 years. Now, besides it being illegal to guarantee a return, it brings up an obvious question. If she can see the future going out 5 years, why couldn't she see that in the last year, the stocks in her ETF will cause it to drop 50%? That's like saying the weatherman cannot tell you if it's going to rain today, but he knows for sure that it's going to rain on a specific day 5 years from now. If she could really know what will happen with her stocks in the future, why didn't she go to all cash at the top and save her investors a 50% drop? You already know the answer to that. She cannot see 5 years into the future any more than she can see 5 days into the future. So now that the ETF is 50% off, is it a good time to buy? That's for you to determine. Now, I love a good, cheap stock, but it has to have earnings and a track record. A lot of stocks that lose 70, 80% or more are usually down that much because their continuing prospects are getting dimmer or because they were overinflated during bull market enthusiasm. When the party is over and the hangover comes, a lot of people will look in their portfolio and say, why did I hold these risky stocks with sky-high valuations and no earnings? For me personally, I would rather load up on some unhealthy ice cream than the ARKK ETF that is currently on sale for 50% off. I'm going to go eat some of my $1.50 ice cream now, so if you like this video, hit the thumbs up, and I'll see you in the next one. Thanks for watching, guys.